The third quarter delivered solid investment returns across all major asset classes, despite periods of market volatility. Some weaker than expected US employment data briefly heightened fears of a recession and led to short, sharp sell-offs in global equity markets in August and September. However, in both instances, these sell-offs were followed by equally strong recoveries as recession fears eased on the back of more resilient economic data and expectations of interest rate cuts. Over the quarter, we also saw a broadening of returns in the share markets, with previously underperforming areas showing strength. Value sectors, small companies, infrastructure, property, and Chinese shares all posted strong gains for the quarter. As shown on the chart on screen, the Chinese equity market delivered an impressive 36% rally in September on the back of a series of stimulus announcements designed to boost China's economic recovery. However, the jury is still out as to whether this stimulus will be enough to reboot China's flagging economy, with the Chinese market giving back some of its gains in October. Closer to home, Australia's share market outperformed its global peers thanks to strong contributions from the banks and a late China-fueled rally from the materials sector. In fixed income markets, bond yields fell over the quarter on anticipated rate cuts, driving bond prices higher. Looking ahead, we see ongoing economic resilience and the beginning of a rate-cutting cycle as tailwinds for investment markets. As shown in the chart on screen, expectations of interest rate cuts have moved materially in both the US and Australia over the past 3 months. The market is now expecting central banks to cut cash rates to around 3% in both markets over the next 18 months. Falling interest rates are generally good for all asset classes, but we see infrastructure, property, small companies, and growth assets as being particularly well positioned to benefit from falling rates. The upcoming US elections will be a focal point for markets in the last quarter. While there are some clear differences in style and policy between the two candidates, most notably on fiscal, trade, and immigration policy, we don't see the election outcome having a material impact on markets. Our primary focus remains on the fundamentals of the US and global economy and the companies that we invest in. On that note, some risks remain, particularly if the economic slowdown accelerates due to rising unemployment or weakening consumer demand. We also remain wary of elevated valuations in many markets and continue to be selective. That said, the balance of economic and financial data continues to point to a soft economic landing and a positive outlook for investment markets.